Welcome to the deep dive. If you're watching the markets or reading the news or honestly even just trying to book a meeting these days,
Mm,
we're right in the middle of this huge, undeniable tech golden age. And it's all centered on AI.
it really is everywhere.
What's truly staggering, though, is the speed, the
Yeah.
velocity. Our sources point out that OpenAI, the company that basically kicked off this whole global frenzy,
Yeah.
it went from what someone called a parlor game to a pillar of the global economy.
Yeah.
I mean, less than 3 years, the amount of investment.
hmm
It's just astonishing.
And that speed, that scale, that's exactly why we need to dig into this.
Yeah.
Our mission today really is to get past this surface level market buzz. We're zeroing in on some pretty serious detailed concerns.
Read by whom?
Well, by financial experts like Jeffrey Sonnenfeld and Stephen Henriques, they're basically arguing this boom looks more and more like a massive overinvestment bubble. And crucially, they lay out three very specific, very plausible ways it could burst.
Okay, so 3 ways the bubble bursts. But let's start with the financial situation right now, because you described it as a knot. And it really feels chaotic.
It is.
It's not just a market, is it? It feels like this closed loop. Everyone seems tied to the success of maybe 2 or 3 core companies. The interconnectedness. It honestly feels a bit like a financial house of cards.
That's a perfect way to put it, a house of cards. Because the lines between, equity stakes, revenue streams, who's a customer, who's an investor, they're just totally blurring.
Right.
Look at this tangle the source material highlights. OpenAI takes a 10% equity stake in AMD, their chip supplier.
Okay.
Then Nvidia, which is the key supplier right now, they're turning around and investing $100 billion into OpenAI.
Wow. Okay, so the supplier invests in the customer who's buying their stuff and also takes equity in another supplier.
Exactly. And the loop gets even tighter. Microsoft is a huge OpenAI shareholder, we know that. But Microsoft is also a major customer of CoreWeave.
Another data center company.
Right. And guess who holds significant equity in CoreWeave?
Let me guess. Nvidia.
Nvidia. You got it. It's fascinating, this concentration of risk. And there's one final piece I found in the sources that just drove it home for me.
What's that?
Microsoft, just Microsoft alone, accounted for almost 20% of Nvidia's total revenue as of their 2025 fiscal fourth quarter.
20% from one customer who's also tied up in this whole equity web.
Precisely. This whole group, they seem to be using equity investments to finance these enormous build-outs rather than just pure revenue deals. So if one company in that chain stumbles, well, the shockwave gets massively amplified, doesn't it?
That concentration definitely sounds like the foundation for risk we need to talk about later. But, the proponents defend it. They point to the sheer scale, right? How do people like AMD CEO Lisa Su frame this spending spree?
Well, Sue basically dismisses the bubble talk completely. She calls it a decade-long super cycle, not some boom and bust thing.
A super cycle.
Yeah. And look, if you just look at the raw numbers, the metrics, you can understand why people are so bullish, so enthusiastic.
The scale is just immense, isn't it? I saw that AI-related capital spending, just in the first half of 2025, was so big it actually outpaced the U.S. consumer as the main driver of economic growth.
That's right, accounting for 1.1% of GDP growth overall. It's huge.
And it's really concentrated growth, too.
Yeah.
Since ChatGPT launched, November 2022,
Mm-hmm.
AI stocks accounted for 75% of S&P 500 returns and 80% of earnings growth.
Yeah.
And 90% of capital spending growth.
Exactly. So this isn't some broad recovery across the board. It's fundamentally an AI rally.
And it's not just the giants, right?
Yeah.
Venture capital world seems to have gone completely all in.
Oh, absolutely. PitchBook data showed for the first half of 2025, almost 2/3 of all U.S. VC deal value went into AI and machine learning startups.
2/3. Wow, what was it before?
Just 23% in 2023. So a massive jump.
Okay, but if we connect that back, this kind of rapid, super concentrated growth,
Yeah.
that's exactly what makes industry veterans nervous, isn't it?
It is. And you're hearing these clear warnings now, not just from outsiders, but from major leaders who are, kind of ironically, benefiting hugely from this boom themselves.
Like who?
Well, Goldman Sachs CEO David Solomon, he explicitly said he expects a lot of capital that was deployed that doesn't deliver returns. Amazon founder Jeff Bezos called the current environment kind of an industrial bubble.
Even Bezos.
So even Bezos. And maybe most surprisingly, Sam Altman, the CEO of OpenAI itself, warned that people will overinvest and lose money in this phase.
That's a pretty clear warning shot, isn't it? Especially coming from the companies, right at the center of it all. When the insiders sound the alarm like that, Well, that should make you, the listener, pause and think.
It absolutely should. And these aren't just public statements. These concerns are echoed privately, too. The Yale CEO Summit, they polled over 150 top CEOs.
Okay.
And yeah, the commercial outlook was mostly enthusiastic, sure, but a really significant chunk, 40%, believed a correction was coming soon, specifically because of AI exuberance and this overinvestment.
40%. That's a big number, thinking a correction is imminent.
It's a massive pocket of serious internal concern. People are worried behind closed doors.
Okay, so let's pivot a bit. We've heard the market warnings. Let's get to the fundamental question. Is the actual technology generating the kind of returns that justify these, frankly, astronomical valuations?
Yeah.
What are the real limitations of AI right now?
Yeah, that's the critical question, isn't it? It brings up this whole issue of the fundamental value being created. The sources we looked at identified two key problems with this massive valuation. The first one involves data contamination.
Data contamination. What does that mean in this context?
Well, computer scientist David Siegel, who was actually an early AI student at MIT, he warned that these really impressive benchmark results we see getting published all the time.
Yeah, the scores keep going up.
Right. But they might be impressive simply because the AI's training data actually contain the answers to the benchmark problems it was tested on.
Wait, so it's like giving a student the answers to the test before they take it and then being amazed they got 100%.
Precisely. That's exactly the analogy. And if that's happening, it leads to these exaggerated claims about the model's abilities to truly learn, to generalize knowledge.
And if they can't generalize properly?
Then they can't really solve new business problems where there isn't pre-existing training data. And that's where the ROI, the return on investment, is supposed to come from, right?
Okay, so that's one potential issue with the perceived capability.
And this skepticism isn't just theoretical. It was kind of bolstered by a report from Apple suggesting that the actual reasoning abilities of many current AI models, they're just not as sophisticated as the marketing hype suggests.
So the models might look fantastic in the lab under specific test conditions, but their real-world usefulness could be questionable.
Potentially, yes.
Which leads us right into the second problem. And this one sounds perhaps even more alarming, the lack of actual return on investment. ROI.
Yeah, this one is stark. There was a recent study from MIT released just after that CEO summit we mentioned. They looked at 52 different organizations, and their research found that 95% of them, 95%, achieved zero return on investment.
Zero, despite how much spending?
Despite spending somewhere between $30 and $40 billion on generative AI, GenAI, across more than 300 different initiatives.
Zero ROI on billions and billions spent. That's an astonishing disconnect, isn't it? Between the hype and the reality on the ground. You really have to pause and think about that.
It's a huge gap.
How can that possibly exist? I mean, it strongly suggests the technology isn't really replacing human labor on a large scale yet. But what about the future? The predictions about AI's impact on jobs seem to be all over the place.
They really are wildly different. They range from, well, catastrophic to quite optimistic.
Okay, give us the extreme view first.
On the extreme end, you've got Anthropic's CEO, Dario Amodei. He suggests AI could wipe out maybe half of all entry-level white-collar jobs.
Half?
Half. Potentially spiking unemployment up to 10%, maybe even 20% in just the next 1 to 5 years. I mean, that's a truly devastating prediction for the labor market.
Wow. Okay, that's the catastrophic end. What's the more balanced view?
Well, then you have someone like Ashutosh Padi from McKinsey. He frames AI more as a tool for enhanced productivity.
Helping people do their jobs better.
Exactly. Helping already extraordinary people be even better, more effective, rather than replacing them wholesale.
Okay, that sounds more manageable.
And then there's some candid nuance from Rob Hornby, the co-CEO of Alex Partners. He basically admitted that, look, current models just aren't ready for sustaining long chains of activity in ways that displace people.
So not capable enough yet for complex real-world jobs.
That's his assessment. And he went even further, saying that AGI, artificial general intelligence, the kind of AI that could perform any intellectual task a human can, he said it's just not close. So the market seems to be valuing the promise of this future AGI, while the current models are still struggling to even show basic ROI in many cases.
Right. So we've got investment pouring in based on future hopes. We've got these massive interdependencies between the key players, and we have actual concrete evidence that the ROI just isn't there yet for many.
It's a complex picture.
VC pioneer Alan Patricof summed it up well, didn't he? He noted the AI revolution is real, absolutely, but he's highly cautious about current valuations. He warned, and I quote, There will be winners and losers, and the losses will be pretty significant.
A sobering thought from someone who's seen tech cycles before.
Definitely. So the question then becomes, not if a correction might happen, but how. The authors identified three main scenarios for how this bubble could burst, right? And they seem rooted in this whole structure we've been outlining.
That's right. Three distinct possibilities. The first scenario they call concentration, leading to contagion.
Contagion like a disease spreading.
Exactly. Given that most of these multi-billion-dollar deals involve the same small group of highly interconnected companies, OpenAI, Nvidia, Microsoft, Google, maybe a couple of others, if the big, bold promises of AI don't materialize quickly enough, or if one of them stumbles financially, the sheer dependence among these players could trigger a devastating chain reaction, a widespread collapse.
They're sort of like the 2008 financial crisis,
Yeah.
but driven by tech promises instead of mortgages.
That's the parallel they draw. And it's driven by failed technology promises. Take a very public example. OpenAI's massive commitment to Oracle.
Right, the $300 billion deal.
Yeah, $300 billion over 5 years for computing power. That averages out to $60 billion a year. That news alone sent Oracle shares soaring by 40%.
Huge jump. But you're saying that stock market euphoria might be masking some underlying risk.
Immense risk, potentially. Recent reporting, I think it was CNBC, suggested that despite that stock surge, Oracle actually expects to lose considerable sums of money on these data center rentals, mainly to OpenAI.
Lose money on a $300 billion deal. How?
Well, the costs of building out and running that capacity might outweigh the revenue initially. They apparently already reported a $100 million loss in just one recent quarter related to this.
Wow.
So if one pillar in that highly concentrated, very dependent structure starts to crack, maybe OpenAI can't meet its commitments, or Oracle's losses become unsustainable, the risk of contagion spreading through the whole ecosystem is extremely high.
Okay, so that's the financial entanglement risk. Scenario one, contagion. What's the second scenario? You said it wasn't about cash flow.
Right. Scenario two is quite different. It's called governance conflict, exposing AI shortcomings. This is less about money running out and more about catastrophic human failure or really poor oversight.
Okay, governance failure, like we saw with crypto. FTX and Sam Bankman-Fried, that kind of thing.
Exactly that kind of parallel. The sources draw a direct line to the crypto market meltdowns of the early 2020s, where terrible governance led to disaster.
But AI is much bigger than crypto ever was, right?
Exponentially larger in terms of perceived value and integration into the economy, which means the potential damage from, say, a bad actor or really questionable internal practices or just a systemic failure due to poor oversight, it's significantly greater.
So what would that look like? What's the specific risk here?
Well, this scenario includes the nightmare possibility of a major, widely used, publicly available AI model going rogue.
Going rogue, like malfunctioning badly.
Malfunctioning spectacularly, maybe unpredictably, and inflicting significant widespread damage. Perhaps to financial markets, or maybe even national security systems, something that causes real harm.
That sounds serious.
It is. And these CEO concerns about the probability of doom, as some call it, from AI misuse or malfunction, they're not just hyperbole for the cameras.
You mentioned Amadeus from Anthropic earlier.
Right. He estimated publicly that there's maybe a 25% chance of things going really, really badly. A 1 in 4 chance.
25% chance of disaster.
That's his estimate. So if a major model did have a significant high-profile failure like that, the fallout would be immediate. You'd likely see a multi-billion-dollar moratorium slapped on comparable AI systems overnight. The market consequences would go way beyond just a typical financial correction. Trust would evaporate.
Okay, that's a chilling scenario. Governance failure leading to catastrophe. What's the third way the bubble could burst? You said it was technological.
Yes, the third one is fundamentally about the pace of innovation itself. Emerging innovators' disruptive substitutions. Basically, the risk here is that new breakthroughs make today's massive investments obsolete almost overnight.
How would that work?
Think back to the dot-com bubble again. Bethany McLean pointed this out. Companies spent insane amounts of money overbuilding fiber optic cable infrastructure in the 90s.
Right, laying cable everywhere.
Exactly. Then, suddenly, a technological breakthrough dramatically multiplied the data capacity of the existing fiber cables. Exponentially.
So much of that newly laid expensive cable wasn't even needed anymore.
Precisely. It rendered a lot of that incredibly expensive overbuilding totally unnecessary for decades. You had all this dark fiber sitting unused.
Okay, I see the parallel. How could that happen with AI infrastructure? infrastructure?
Well, right now, hundreds of billions of dollars are being poured into these huge conventional data centers, all based on current semiconductor chip designs.
The Nvidia chips and similar ones.
Right. But what if there are radical innovations just around the corner? Maybe in semiconductor design itself, completely new architectures. Or perhaps major advances in quantum computing happen faster than anyone expects.
Then the current data centers might become less valuable.
Or potentially even useless, or at least vastly less efficient compared to the new tech. Much of that massive investment currently being deployed could quickly become obsolete. You'd have this immense amount of spare compute power lying around based on the old tech.
And the investors who backed those billions in infrastructure.
It might take them years, maybe decades, to generate any kind of return, if ever. You'd see mass write-downs. It's the risk of betting huge on today's tech when tomorrow's breakthrough could change everything.
So 3 very different ways this could potentially unravel. Contagion from the financial tangle, governance failure leading to a catastrophic event, or substitution where new tech makes current bets obsolete.
That's the framework they lay out.
Okay, so wrapping this up, what does this all mean for you listening right now?
Yeah.
Look, the AI revolution is clearly real. The potential for productivity gains. It's coming.
No doubt about that.
But these cautions around the short-term valuations, the sheer scale of investment versus the current ROI, they're mounting. And crucially, they're not just coming from, Luddites or skeptics on the sidelines.
Not at all. They're coming from the very industry leaders, the CEOs and investors who are actively driving this revolution forward.
Which makes them harder to ignore.
Absolutely. And, to understand where we might be headed, sometimes looking back helps. The historical lens is really useful here. Charles Mackay's classic book from 1841.
Extraordinary Popular Delusions and the Madness of Crowds.
That's the one. It examined historical manias, things like the Dutch tulip craze, and honestly, it feels incredibly relevant reading it today in the context of AI investment.
What's the key takeaway from Mackay?
Well, we wanted to leave you with his really enduring observation about group psychology. He wrote, "Men, it has been well said, think in herds. It will be seen that they go mad in herds while they only recover their senses slowly, one by one."
Think in herds, go mad in herds, recover one by one. That's quite a thought to end on.
It is.
So, the final question for you, the listener, is this. When you think about those 3 potential scenarios for the bubble bursting, the contagion risk from financial links, the governance risk from a catastrophic AI failure, and the substitution risk from new tech invalidating old investments, which of those 3 feels like the least recognized risk right now? The one people aren't paying enough attention to, and why? Something to definitely think about as you watch those AI valuations continue to soar.